Hi there, welcome to the video. Today we're going to start a new program. If you remember the last time, if you haven't watched those video, the last time we did some experiment. And in that experiment, we look at selling puts and selling cash secured put and buying calls. Selling cash secured put at about 30%, 30 delta between 90 to 100 days, or versus buying calls at 70 delta. We try to test the idea that because most of the people would say buying calls is a madness. But from our experiment, what we found out is that buying calls in a trending market is very profitable. In a trending market, when you buy calls, an uptrend market, calls are very profitable. In sideways market, selling puts is more profitable than buying calls or even buying stocks in a sideways market. So it was a wonderful test that we did, and the calls made a lot of money. If you want to make money and you are in an uptrend market, buy calls. Buy calls, dip in the money calls at close, if you can, at least somewhere 90 to 100 days. You're gonna be in this, and you may have to use some indicators. For us, we were using our trend tracker indicator. And the difference between the two programs, the profit between the two is basically 1 to 2. Even that Friday, the Friday before we stopped the experiment, the market dropped down significantly. But we still, if you look at the market on that Friday, SPX, you can see it drops all the way down here. Then the profit was close to 4 to 2. But because of the significant drop, the profit was moved to about 2 to 1. Buying calls can be very profitable. So today, we're going to start a new program. In this program, we're going to do a test. We're going to test two common strategies. And what we want to find out is which one is more profitable. Because, hey, people would say, I love trading, but if nobody is going to stay in there if they're not making money. Is the profit number one objective? Does not make this too nice. Trading is painful. Nobody is going to go there just because I love trading. You want to make a profit. As you continue doing it, you didn't make any money in there. If you don't make up money, for sure you will get out of that. Get out of it. So, and we want to know which one is more profitable, and we want to know which one to pick based on our risk acceptance. How risky are these? And then what level are we willing to go? And the next one, we want to identify between the two on the various, we want to identify what are the difference on the various market conditions. Okay, the market is trending right now. Which one would do better? Oh, the market is going down. Which one would do better? The market is on sideways. Which one will do better? And what we're going to be doing, we're going to use the Magnificent Seven stocks. Currently, those are the highest, I would say. They compose a significant portion of the stock market. And therefore, we're going to focus our experiment on that because they are very volatile stocks. And again, anybody in the market, pay attention to them. So the seven would be Amazon, Apple, NVIDIA, Microsoft, Tesla, Google, and Meta. What are we going to test against? We're going to do a cover call. So it'll be a cover call strategy and the whale strategy. For us, we're going to change the covered call a little bit. So as we go in, you would see we would buy a stock and then sell 30 days call at 30 delta right away. Why are we going for 30? Because we want the stock to go up a little bit. We want to give some value. We want the stock to have some upward movement a little bit. Some people would just do it at the money. They will sell the calls at the money. But for us, the reason you do a cover call, because you want the stock to be going up a little. So basically, if you buy at 30 delta, that is giving us about 70 delta total because the stock is 100 delta. And if you sold 30, a call at 30 delta, that's giving you about 70 delta. All right. Now, the next one, what we're going to do, we're going to get out of the trade when the stock drop more than 20%, 25%. If you stay in a trade until the stock drop more than 25%, we would consider that not acceptable. We wouldn't stay in that trade. Trying to see how much does this one drop. Let's see if I can get this expanded. How much does the stock drop on this one? Can I see? It's not showing me. Maybe let me do this. Let me start here. Okay. So we can see just that alone is about 3.3 about 3.3 or 3.4%. Now, if the stock drop more than 25%, that's a lot of drop. If you stay in that, you must have a very strong gut for anybody to stay in there like that. Look at this one. Let's look at this. This is what? This is also showing about 3%. I mean, for somebody to be in the trade that wide, I don't know, 25% from the thing. This one looks so small to me, but possibly that's what it is. I was thinking that it would be much lower than that. But again, we may have to adjust that. We would see. But 25, if a stock lose its value from the high to that level, we will get out. There's no way we want to stay in that trade. We will close this the stock, and we will close the trade completely. So whatever we are in, we're just gonna close that. Number 3, then the step 3, we roll the call at 80 to 90% profit. When we receive profit more than 80 to 90%, we want to close that and then open another one. Yeah, we want to, I mean, it means this is going very, very fast. It's going very fast. Possibly it's going down, the calls are getting profit. So we want to follow the stock a bit. We want to capture. That means we are losing money. When you're making money on calls, you are losing money on your stock. So when that is happening, we want to, because it means either the stock is going on a sideways for an extended period of time, or it's dropping. So we want to capture more of those losses as we go on. We want to do that. All right. So the next level, what is our next level? Now, we would roll the call in a strong trend. When the trend is very high, trend is going very high, we know that the calls would be getting in the money, or they would increase in value quite significantly. And therefore, whatever we're making on the stock would go down. Because remember, when the calls are going up from 30, it will see going 40, 50, but the stock is only 100. So whatever you're getting out of the stock, you are losing in there. So when the stock is going at a very high rate, we want to just roll our calls. We don't want to lose our stock. We will just forward, we will just roll it up and keep moving. Then the strategy two, we would sell, that will be the wheels. We would start with selling 30-day puts at 30 delta. 30 days put at 30 delta. We will roll the put at 80 to 90% profit. And we will take assignment when the price drop below the strike price. Immediately taking the assignment, we would sell a call against it, 30-day calls at 30 delta. Then, as we continue doing that, as we continue selling calls against it, we would go ahead and take assignment. If they take it from us, we will go back and start. We would continue the process all over again. So here, we don't put a limit on getting out of the trade. We would only stop it when it is very clear to us that there is a bear market. And to win in the process is impossible. Because remember, this is a positive delta strategy. In a bear market, the market is in a negative delta. Therefore, there's no way you can make money with a positive strategy in a negative delta market. You will see people trying to. You will continue doing. You have to change your strategy to a negative delta, and then you would make money in a negative delta market. That's something that we have to understand. You will see people in a bear market trying to make money doing positive delta strategies. You're not going to make money on that. That's fixed. Okay, so we started this program yesterday. Yesterday, we went in, no, day before yesterday. We went in and buy Apple. So we buy Apple. We buy 100 Apple. So here, our cover calls 100 Apple. And we sold a call against it. It gives us about 70 delta. Same thing for Meta. So Meta, here is a call here. And because our account that we use, we ran out of money in there. So we have to use the IRA account here to get the Meta. So Meta, we have 100 stocks and we sold a call against it. That also about the same level. Then we went ahead and did the same thing for, we did Apple, Meta, Microsoft, the same process, and it's 20 to 30 days. So you can see how many days are left now. And Tesla, we did the same thing. Tesla, then you have the Google, same, and NVIDIA, same process. So today, when we look at it, now you can see today we make about $3,000. Sorry, this is today. This is today. So what do we make today? This is about 2,000, 2,200, 2,200. We make that. And here today you can see, so for this other one is the wheel strategy. We went in, sold a put. About 30 days, Amazon the same, Google. So we sold a put for each of this. Now, looking at this, there's no adjustment that needs to be done today. Everything is looking fine. We see some positive movement in NVIDIA. Look at it. So this is showing you how volatile some of these stocks are. We saw Amazon is a little negative, but if we go in here, let's go look at them. So here we basically put equal amount of money. The difference is not a lot between, because for this it's a cash secured put. We don't have a margin on this thing. A little bit of margin, but the margin is not that good. It's not that good. So, but again, because of the fact that we have these other ones, our buying power effect is not that clear. It's not, because we have the some of the things here. But if you look at it at this point in time, they are all doing well. The puts, naturally, because puts are just 30 delta, the amount would be less than what these stocks are showing, because those are already 100 minus the call delta that give you about 70%. But again, we're going to look at the characteristic of each of these trades and where can we use it and how can we profit from it. Now let's look at let's go in and look at some of the stocks we have. We have Apple, AAPL. So we have Apple. We started this program around here. So what I would do, I would take this. Right here. Activate. Somewhere, put it right there. Okay. So what is the strike price of the put? What is the strike price of the put for Apple? 240. So I'm gonna go in and put it at 240. I think that'll be better. So we activate it, bring it to 240. Great. So now, a month from today, a year from today, we would be able to track where we enter and then how the stock is doing. So under my usual process, under my usual trade, this is a signal. If I am buying calls, 90-day calls, I have the signal to buy Apple at this point. So if you follow me, pay attention to this. Pay attention to pay attention to this candle here. See how this indicator would go with it. Okay. But if I'm doing calls, strategy, this is what I will be buying today. Now let's go to Meta, MET. META. So Meta is down a little bit today, not much. So same process here. I think I'll do this later on after the video. But this is where we are right now. I'll stop it here. I think we have been on the air for quite some time, but this is what we should be expecting in the coming days. I think it will be fun. It'll be a good learning lesson for all of us. We do this experiment, you go do it and make your money. Thank you very much.